All right, let's get right into it. For most of us, the stock market seems pretty straightforward. It opens at 9:30, closes at 4, and that's that. But what happens after the lights go out? Well, that's what we're talking about today. We're going to explore the world of trading after dark, a place where the rules are totally different. The risks are way higher, and believe me, the action never really stops.
You really need to think of that 4 p.m. bell less as an ending and more like a gateway. It's the exact moment when the familiar, regulated world of the stock market that we all know gives way to this sprawling, decentralized landscape that just operates around the clock. This is where the big news hits, and it's where a completely different kind of trader comes out to play. So welcome to the world of extended hours trading, or EHT. And look, this isn't just about having more time to trade. No, it's a fundamentally different environment. If the regular market is this brightly lit 8-lane superhighway, think of extended hours as a whole network of unlit, winding country roads. Yeah, the destination might be the same, but the journey, it's a whole lot more treacherous. And this right here just lays out the contrast perfectly. During the day, you've got tons of liquidity, buyers and sellers everywhere, and a single central price that everyone agrees on. The whole party is happening. But after hours, everything changes. The liquidity totally dries up, prices get scattered across different networks, and you're playing a completely different game, often against players who have some pretty serious advantages over you.
Okay, so if you're going to navigate this new territory, you're going to need a map. The 24-hour cycle isn't just one long, endless session. It's actually broken up into these distinct phases, and each one has its own personality and its own quirks. So let's break down that timeline. So it all kicks off at 4 p.m. Eastern. That's when the after-hours session begins. That then flows into the overnight session at 8 p.m., which is what really bridges the gap between the U.S. close and when Asia and Europe open. Then, at 4 a.m., the pre-market session starts, and it builds momentum right up until the main event, the 9:30 a.m. open, when the whole cycle starts all over again.
What's so interesting here is how this table really shows you the personality of each session. You see, pre-market liquidity starts out thin, but it builds as we get closer to the open. After hours, though, that can be incredibly volatile. It's almost entirely driven by things like company earnings reports. And the overnight session, well, that's the true Wild West. It's fragmented and completely dominated by global players.
So, what's the tech that makes all of this possible? It comes down to these things called electronic communication networks, or ECNs. These are the engines of the after-hours world. Instead of a human market maker standing there creating a market, these are just digital platforms that match up buy and sell orders automatically. It's super efficient, but, and this is a big but, it comes with a huge catch.
And this right here is the absolute crucial point you have to understand. Because these ECNs aren't all linked together, there's no single unified price for a stock. An order on one network isn't even visible on another. What does that mean for you? It means the price you see might not be the best price out there, or even the most recent one. The market is literally shattered into different pieces.
This fragmented, low-liquidity environment, well, it basically creates a minefield of risks for the average investor. And these aren't just some theoretical dangers I'm talking about. They are structural flaws baked into the market that you absolutely need to know about before you even think about placing a trade.
And hey, don't just take my word for it. FINRA, the main industry regulator, has a specific rule, Rule 2265, that forces brokers to warn you about 6 specific hazards. And trust me, they do this for a very, very good reason. Let's start with one of the most immediate and costly risks of all.
During the day, if you look at a popular stock, the bid-ask spread, that's the little gap between what buyers are willing to pay and what sellers are willing to accept, it's often just a single penny. It's tight, it's efficient, and it's cheap to trade.
Now look at this. After hours, that same exact stock might have a spread of 50 cents, maybe even more. And that's not a potential loss we're talking about. That is an immediate, guaranteed cost just to get into the trade. You are instantly down 50 cents a share the second your order gets filled. That is the price you pay for low liquidity.
And that wider spread is just one of the 6 core risks that FINRA makes sure you know about. You've got lower liquidity, which we've been talking about, which of course leads to higher volatility. You've got prices that can swing wildly from the close to the next open, those unlinked markets, the crazy impact of news, and of course, those killer spreads.
That low liquidity risk isn't just about spreads either. It can lead to something called a partial execution. So you might try to buy, say, 500 shares, but you only get 100 of them filled because there just aren't enough sellers. Now you're stuck with this tiny position, totally exposed and vulnerable to a huge price move you just weren't ready for.
So knowing all these dangers, how in the world do you survive? The extended hours market is a hunting ground, and if you're not careful, you are the prey. But with the right defensive playbook, you can absolutely protect yourself from the predators that are lurking in these thin markets.
One of the most common predatory tactics out there is something called stop-loss hunting. This is where big institutional players can actually see where retail traders, people like us, have clustered their protective stop-loss orders. And then they deliberately push the price down just enough to trigger them, which creates this cascade of forced selling. And the process is just brutally effective. First, they scan. They look for where all the stops are placed, usually at really obvious round numbers like $50 or at a recent low. Second, they attack. They'll use a massive sell order to just briefly smash the price right through that level. Third, that triggers a wave of automated selling from all the retail accounts. And finally, they collect. They swoop in and buy up all those shares at a cheap, artificial price right before the stock snaps back up.
So what is your number one defense? It's this. This is the one rule you cannot, ever break. The use of limit orders is absolutely non-negotiable. See, a market order just says, get me in or out at any price, which in a thin market could be disastrously far from what you expected. But a limit order says, only at this price or better. It is your single most important shield out there.
And beyond that, you can build a really robust defense. Stop putting your protective orders at obvious levels like $100. Instead, you can use volatility-based stops that put them outside the typical noise. Don't go all in at once. Try scaling into a position bit by bit. And you know what? Even better, wait for the predators to make their move. A lot of times, the safest entry is right after you see a stop-loss hunt fail and the price starts to reverse.
You know, all these risks and strategies, they aren't just for some niche group of hardcore traders anymore. The entire market is moving in this direction. The walls between these different trading sessions are just crumbling, and we are heading straight towards a nearly continuous 24-hour trading cycle.
And this isn't just me speculating. This is real. The market is already marching towards a 23-hour, 5-day cycle. In fact, the New York Stock Exchange's ARCA platform has already announced plans for a 22-hour trading day. The after-hours market is on the verge of just becoming the market. And that leads us to the final really critical question. While the ability to trade anytime definitely offers a certain peace of mind, right? I mean, it lets you react to news the second it breaks. But it also creates this always-on pressure. It takes away that time we have to disconnect, to digest information, and make rational decisions. So as we build this 24-hour market, we have to ask ourselves, what is the cost to our own sanity?